Following the agreement in principle for a third Greek bailout programme, equity markets have recovered over the last week and year to date are up 8% in local currency terms, or just over 17% in euro terms, following renewed weakness in the euro given the divergence in monetary policies between the US Fed and the ECB. Eurozone bonds are down minus 0.6% year to date, with German 10-year yields stabilising around 0.75%, while peripheral bond spreads have narrowed again on developments in Greece. After some acrimonious discussions over the last 6 months, an agreement has been reached in principle between Greece and its creditors for a third bailout programme of between 82 and 86 billion euros over 3 years, with 20 to 25 billion of the programme being set aside for bank recapitalisations. Discussions on the details of the new programme are now set to begin, with the Greek Parliament having passed legislation committing to implement tax increases, lower pension expenditures, introduce reforms across the economy, repeal measures which were implemented over the last 6 months were contrary to the previous bailout programme, and transfer assets to a privatisation fund, while Eurozone governments have also formally given approval for negotiations to start. The final programme is expected to be agreed and officially begin by the end of August, with a bridging loan of €7 billion having been established last week to enable Greece to pay upcoming commitments between now and the release of the funds under the new programme. While a write-down of Greek debt has been ruled out by creditors, it has been suggested that some soft restructuring of Greek debt could be considered following the first successful review of the implementation of the programme later this year, which could involve an extension of maturities of loans or reduction in interest rates on those loans. Key to the success of the new bailout programme will be the actual implementation by the Greek authorities, which will be closely watched by markets. But the recent legislation passed by the Greek Parliament commits the government to adhering to the required measures, and the programme should remove uncertainties relating to Greece over the medium term. One of the other major developments in markets over the last month was the 36% fall in the Chinese A-share market since early June. The China A-share market historically has been mainly only open to domestic investors, but more recently has been opened to overseas investors. A significant amount of activity in the market is driven by retail investors and is based on margin trading. Given increased provision of liquidity, margin trading surged by over 220% since the end of last year, resulting in A-shares rising by 235% since the middle of last year. In June this year, the authorities attempted to rein in margin trading exposures and introduce restrictions on margin trading, which contributed to the sudden collapse in the market. To support the market, the authorities announced a number of measures, including suspending IPOs, establishing a market stabilisation fund, pledging unlimited liquidity to brokers, and restricting share sales by large shareholders, which put a floor under the market. The level of outstanding margin trading has fallen significantly and is now back close to more normal levels. We believe the risk of economic and financial contagion from the equity market fall is limited. A-shares are still up 110% over last year and 40% year to date, and having recovered 16% from their recent lows, are only back to levels seen at the beginning of April. Despite much of activity in the market being retail related, with only 8% of Chinese households holding equities, and equities accounting for only approximately 12% of household financial assets, both low by international standards, the impact on retail sales and the economy is expected to be limited. The potential losses from margin-related lending within the banking sector are also very manageable, and with stable to declining interbank rates, there are no signs of stress within the financial system due to the equity market falls. With the support measures announced by the authorities, and with excessive margin trading exposures now back close to more normal levels, we believe the worst of the falls in Chinese equities are over, and the potential spillover to the Chinese economy and financial system and hence global markets is limited. With uncertainties relating to Greece being addressed, we believe equity markets still provide upside and can now resume their gentle upward trajectory. Concerns remain relating to the timing and extent of upcoming interest rate rises in the US and the UK, but these are well known about, and with the tightening cycle expected to be gradual, equities can continue to move higher, even in an environment of rising rates as they have done historically, with the improving economic backdrop which is contributing to the higher rates being supportive of earnings and equities. Economic data has generally improved post the soft first quarter, particularly in the US, with the stabilisation of key data points in China also evident in recent weeks, which should be positive for equities. The Q2 earnings reporting season has just begun and is expected to surprise positively, with consensus global earnings forecasts seen as conservative for 2015. The euro is expected to gradually move towards parity against the US dollar towards the end of 2015 and into 2016, when the US finally begins to raise interest rates. Eurozone bond yields are expected to remain in a range for the time being, sensitive on the downside to any further declines in oil prices and inflation expectations, while higher yields would be likely from any upward surprises in growth and inflation. Into 2016, however, yields are expected to generally drift higher on a continuation of improving economic news flow and higher US yields post the beginning of Fed tightening.